What did the credit power index show in February? Are consumers getting more or less squeezed?
Well, the good news is that consumers are getting less squeezed. The bad news is not by much. The credit power index only dropped by about 8 basis points. So while that tells us that we are going in the right direction, it's going to be a while before we get back to pre-recession levels.
And why is this an important indicator to watch?
Okay, well, basically what the credit power index shows is this. When a consumer goes to the bank, they're doing one of two things. Either they're getting a deposit and the bank is paying them interest, or they're taking out a loan and they're paying the bank interest. And unfortunately, the interest that the banks pay out to consumers is a lot lower than the consumers are paying out to the bank. So what the credit power index is essentially showing us is just how much consumers are getting squeezed. And in that sense, it's a very good indicator of how consumers are doing when they go to the bank.
Aside from the headline data, any other surprises in there?
Well, I'd say the biggest surprise is that deposit rates are actually showing some positive signs. Very small positive signs, but positive signs all the same. And that's definitely a good sign because anybody who's looked at their savings account lately knows very well just how poor rates are on that end. The one caveat there is that the improvement that we're seeing on the deposit side has mainly happened on the long-term side, the 60-month CDs, whereas the 12-month CDs have stayed pretty stable. So that tells us that the long-term outlook is good, short-term outlook not so much.
Thanks a lot, Matt.
Thank you.